The U.S. stock market has seen several whipsaws over the past 2 weeks, as traders are largely concerned about the rise in inflation. The general qualm is that strong inflation and ongoing support from stimulus relief packages will trigger the Fed's immature action, a rise in interest rates. Stock traders and investors believe this could derail the U.S. economic recovery. The Dow Jones Industrial Average is up to 60% YTD year-to-date. The S&P 500 has advanced 1.95% YTD, while the Nasdaq NDAQ Composite Index is down by 0.47% YTD. In order to understand the current markets, it is critical to note the performance of these stock indices over the past 2 weeks. The Nasdaq is taking most of the beating as big tech stocks such as Amazon AMZN, Netflix NFLX, Alibaba Baba, Tesla TSLA and many others create chaos. The Nasdaq Composite is down nearly 8%, and today we could see another 2% sell-off. This means that the Nasdaq will officially enter the correction territory. The Dow Jones hasn't sunk much during the past 2 weeks, it has lost only 0.78% of its value. But the S&P 500 has declined over 3% so far. Stock traders are primarily concerned that inflation is picking up steam and getting out of control. Therefore, to bring the situation under control, the Fed will have no choice but to increase interest rates. Generally speaking, inflation and interest have a negative correlation, and the Fed uses the interest rate to lower inflation. Another tool that can also influence inflation is the bond purchase program, traditionally known as the quantitative easing program. We have seen a surge in inflation because of the unprecedented amount of stimulus support in the U.S. Even now, another stimulus package worth $1.9 trillion could soon become a reality and provide a massive boost for the U.S. economy. Traders believe that this stimulus package will further fuel inflation. In addition to this, we have U.S. interest rates sitting at all-time lows. Of course, lawmakers took all these actions to temper the coronavirus's adverse impact, which brought the U.S. economy to its knees. The chairman of the Federal Reserve Bank, Jerome Powell, has tried his best to assure investors and traders that the Fed is not even thinking of increasing the interest rate, a point he emphasized in his 2-day testimony this week. Additionally, Powell said that the Fed would provide enough time for market players to prepare themselves for an interest rate hike. The message was very much in line with his previous comments, and it means that the Fed is far from making any decision to increase interest rates. Generally speaking, traders believe that history repeats itself. The taper tantrum of 2013 is still very much on investors' minds. Taper tantrum happened when the Fed tried to exit from its quantitative easing program, which was put in place after the financial market crash that popped the stock market bubble.